India's stock market has been on a record-breaking run, with benchmark indices like the Sensex and Nifty touching new highs in 2025. Strong domestic inflows, robust corporate earnings, and policy support have fueled optimism, making India one of the most attractive equity markets globally. But with valuations stretched, experts are warning investors to be cautious and not ignore downside risks. One of the biggest concerns is global economic uncertainty. If the US Federal Reserve keeps interest rates higher for longer, global liquidity may tighten, prompting foreign investors to pull funds from emerging markets, including India. Such outflows could spark volatility and corrections. Another red flag is valuation pressure. Indian equities are currently trading at a premium compared to other emerging markets, making them vulnerable if earnings growth fails to match expectations. Analysts caution that sectors like consumer, IT, and mid-caps could face sharper corrections if profit margins contract. Geopolitical risks also loom large. Rising tensions in the Middle East, supply chain disruptions, or a slowdown in China could impact global trade flows, indirectly hurting Indian exports. Additionally, rising crude oil prices would worsen India's fiscal and current account balances, adding pressure on inflation and interest rates. On the domestic side, political and policy uncertainty in the run-up to the 2025 state elections may also unsettle markets. While government reforms have largely supported growth, any reversal or populist measures could dent investor sentiment. However, experts also point out India's structural strengths: strong domestic consumption, digitalization, manufacturing push under Make in India, and consistent SIP inflows from retail investors. These factors are expected to provide a cushion against a steep crash, even if a global downturn occurs. In short, while a full-blown crash may not be imminent, a sharp correction of 10–15% cannot be ruled out in 2025. Experts advise investors to remain diversified, avoid overexposure to high-risk mid-caps, and maintain a long-term view rather than chasing short-term rallies.